Good morning, everybody. It's Jed Joling with eXp Realty. Happy Valentine's Day. It's Tuesday, February 14th today. So this is your reminder. If you forgot it was Valentine's Day, you better get your act in shape. But anyway, I normally do these market updates on Mondays. Yesterday kind of ran away from me, so that's why I'm doing it today. But all the data is going to be based off of yesterday and the previous week, like always. So we'll jump right into it. Yesterday, we had 787 active single-family residences on the market between Jackson and Josephine counties. In relation to where we were at this same week last year, we are up 31% on that number. So last year, this week was 544. In the new listings last week, we had 72, pending 86, closed 45, and 22 expired or canceled. Per the 4-week average, we're up 3.5 on the new count, up just a half on the pending count, up 2.25 on the closed count, and down 6 on the expired and the canceled count. So we saw good numbers. New listings, that's a strong number for what we've been seeing. Pending count, that's the second best we've seen here this last month. And in the last 4 weeks, we've been seeing strong numbers, with last week being the strongest, this week being the second strongest. Close count is going to start coming up more. We're already up a little bit above the 4-week average this week, and I intend that we'll see that start to climb here in the next 2 to 3 weeks as well. Per what our data was this same week last year, we are down 36% on new listings for the week, 37% on the pending count, and 47% on the closed count. So still seeing a lot less closes than we were last year, like we have been seeing here the last couple months. So a quick snapshot of this week's data puts us at 4 months of inventory. Per the 4-week average, it puts us at 4.5 months of inventory. So in terms of measuring inventory off of the months, so 6 months is generally a neutral market. We are under that, so that would mean we are, by definition, a seller's market, though the interest rates have kind of put a twist on that. And the reason that we are seeing such low inventory, in my opinion, is in the last 3 years, we've had such low rates. People bought, more than they thought they could afford, and at 2.5 to 4% interest rates, people aren't going to want to move. So we're seeing now 2 years later, when people would be able to sell and avoid the capital gains, they don't want to sell because they have such a low interest rate. And if they sell, they probably can't go buy the same thing that they bought a couple years ago. And as we know, the last few years, we saw home values come up massively, 30 to 40% easily in the last couple of years. So what I'm calling that is gridlock. And I mentioned this a couple weeks ago. The gridlock meaning people are either stuck because they want to be stuck with a better mortgage rate, a lower payment, or they're stuck because if they sold this, they can't go buy that, or they can't buy the same thing. So we're seeing less inventory than would be deemed healthy for the market at this time. But things are moving slower than they were just because of the interest rates. And speaking of interest rates, a little bit discouraging, but we saw interest rates come up 0.5% here in the last week. So the national average for a 30-year conventional today is 6.5%, and the national average for a 30-year FHA fixed is 5.9%. So hopefully we'll see those numbers get better. Those were yesterday's numbers. Today's numbers have not come out, and I'm afraid today's are actually also going to be a little bit higher. And that's because our January inflation report was released this morning. And in the January inflation report, they had predicted that we were going to see about 6.2% annual inflation. Well, it came out and it's 6.4%, so higher than they expected, which is generally not a good thing. And in my opinion, 6.4% is not great at all, because we are at 6.5% in December, so not really an improvement over December. And our month-to-month inflation in December was 0.1%, which is not bad. That's pretty good. But month over month for January was 0.5%, so 0.5%. And when you have an annual target inflation number of 2% for the economy, 0.5%, times that by 4, we're at 2%. So that is not great. It doesn't take long to hit 2% if we're going 0.5% month over month. So we'll see what that does to our interest rates. It's probably going to negatively affect them, at least for today, maybe even tomorrow. We'll see what happens after that. As we know, January jobs report came out and the economy did a lot better than expected, adding, I think it was 517,000 jobs to the economy. And that's what started to kick rates back up a little bit, just because the economy started doing so well. Well, if we have, jobless claims are the lowest in like 50 years, then the rates are going to stay high because obviously things are still moving. So why lower them and move things even more and cause more inflation? So we'll see what happens there. I would hope that they start to move lower, but we really aren't going to know. And the Fed is going to probably come out and have a plan to attack this inflation, either in the form of more rate hikes than they intended or something else, but we're certainly going to find out. So that's all of the data I have for you today, all the information I have for you today. Hopefully everybody has awesome Valentine's Day plans, and if you forgot it was Valentine's Day, here's your reminder. So hopefully you have plans with either your spouse, loved ones, family, or friends. Everybody have a great rest of the week. We'll talk to you next Monday, and as always, feel free to reach out, questions, comments. I appreciate feedback. I love hearing from folks, and it's always good to know what people are thinking. So thank you for all the referrals from those out there that are throwing my name around. I really appreciate that as well. We'll talk to you later.